Welcome to the deep dive. Forget the noise, we're cutting straight to the core of what makes a successful stock trader.
Yeah, that's the plan.
Today, we're really digging into the hard-won wisdom of some of the giants, pulling crucial insights from lessons from the greatest stock traders of all time.
Right.
Think of this as your shortcut to understanding the timeless principles that powered these legendary market careers, and maybe how they can inform your own approach.
Exactly. We're plunging into the minds of five, titans. Jesse Livermore, Bernard Baruch, Gerald Loeb, Nicolas Darvas, and William J. O'Neill.
Quite a lineup.
It is. And these individuals navigated wildly different economic climates, from roaring booms to devastating busts.
Yeah.
Yet each one carved out lasting success.
And what's really striking is the overlap, isn't it?
That's what's truly remarkable. The overlap in their core strategies. It proves that some truths in the market just endure.
And that's the key takeaway right up front, really. Despite the decades separating their careers, the unique challenges they faced, these masters operated on principles that are surprisingly consistent. Why? Because the fundamental engine of the market, human nature, with all its predictable swings of fear, greed, hope, and, let's face it, sometimes a lack of understanding.
Right. That part stays pretty constant.
It really does. So let's get started. Let's unpack the experiences of Jesse Livermore first.
Okay, Livermore. His early days, they were something else. Betting on stock price movements in these places called bucket shops.
Which weren't really exchanges, right? More like betting parlors.
Essentially, yeah. Prediction markets without actual stock ownership. And they were brutal. These shops operated with this razor-thin 10% margin.
10%? Wow.
Yeah, so a bet against you by just that small amount meant instant wipeout. Gone.
Ouch.
So this harsh introduction, it forged an unshakable principle in Livermore.
Yeah.
Cut losses. Ruthlessly. For him, this wasn't just, a good idea. It was fundamental survival.
Survival, literally.
Absolutely. His very first trade, actually, was a shared $5 punt on Burlington with a friend, based on a tip. Kind of highlights that high-stakes environment.
It's almost unbelievable that such a precarious start, those unforgiving rules, could lay the foundation for such a monumental career. But it wasn't a straight shot to success, was it?
Oh, definitely not. Our sources highlight that after an initial taste of profits, Livermore's impatience and, frankly, his impulsive trading quickly erased those gains.
Ah, the classic early mistakes.
Exactly. And this led him to a critical realization. The absolute necessity of rigorously analyzing his mistakes, really digging into why he lost.
And that commitment to self-assessment, that seems to be a recurring theme among these top traders, doesn't it?
It really is. Livermore learned that true speculating wasn't about constant activity, chasing every flicker on the tape.
Right.
It demanded patience, waiting for those high-probability setups, and acting decisively only when the market presented clear signals.
But initially, he fell into the traps.
He did, acting on flimsy tips, overtrading, mistakes that still plague so many traders today, honestly. He then grasped the paramount importance of understanding the overarching market trend, the big picture.
So less prediction, more interpretation.
Precisely. Instead of futilely trying to predict the future, he focused intently on deciphering the market's current stage and aligning his trading accordingly. He learned to trust his own observations above all else.
And this fundamental shift in his approach, that's what paved the way for his core trading strategies, right? The probing and pyramiding.
Yes, exactly. Livermore developed his probing strategy as a way to cautiously test the waters. He takes small initial positions first.
Just dip a toe in.
Right. Then, if the trade started to move favorably, he'd deploy his pyramiding strategy, adding more shares as the stock price climbed.
And crucially, adding at higher prices, right? Averaging up.
Yes, always averaged up. Buying more at higher prices. Now, that's psychologically challenging for many people. But it's a far more effective way to build those really big winning positions. And, given his increasing influence, he often used multiple brokerage accounts to kind of hide what he was doing.
Smart. Now, there's that pivotal period around 1914 when Livermore actually faced bankruptcy. It's a stark reminder, isn't it, that even the best aren't immune to huge setbacks.
Oh, absolutely.
How did he manage to bounce back from that one?
Well, that period really underscores a vital lesson. Even flat, directionless markets can be dangerous. You can get chopped up.
Yeah.
He was heavily in debt. The market offered few clear opportunities, and so Livermore declared bankruptcy. But his ability to rebound is truly instructive.
What happened?
In 1915, a brokerage extended him some credit. And for 6 solid weeks, he did nothing. Nothing but immerse himself in studying the market's behavior.
Just observing.
Just observing. And he rediscovered the significance of par levels, those round numbers like $100, $200. They often act as psychological magnets or resistance points.
Ah.
So he bought Bethlehem steel at $98, just below that $100 par level. Then he aggressively added more at $114 after decisively broke through $100. And then he exited at $145.
And the profit?
Pocketed a substantial $50,000 profit, which back then...
It was huge money.
Huge. This success didn't just rebuild his capital. Just as importantly, it restored his confidence in his methods.
And as the Roaring '20s unfolded, his understanding of the market just kept deepening, didn't it?
Absolutely. The 1920s really cemented for Livermore the indispensable value of experience. He recognized the critical need to identify market leaders.
The strongest stocks in the strongest sectors.
Exactly. Those stocks within the strongest industry sectors that demonstrated the greatest profit potential. This underscored the importance of understanding the underlying fundamental drivers, too.
Right, the why behind the move.
Mm-hmm. He also keenly observed how stocks within the same industry group tended to move together, in concert. He called it group tendency.
And that proved insightful later on.
Especially leading up to the 1929 crash, yes. Very insightful.
Now, it seems almost counterintuitive to conventional wisdom, but Livermore championed buying stocks as they broke out to new highs, pushing through resistance, rather than trying to snag perceived bargains lower down.
Exactly. This was radical then. And honestly, it still feels radical to some people today. It departed from the prevailing buy low mentality.
Why did he favor that?
Livermore learned the hard way that trying to catch falling knives, buying stocks that are actively falling, was often just a recipe for disaster.
Makes sense. Painful sense.
He emphasized over and over that his consistent losses stemmed from deviating from his own rules, while his profits flowed when he stuck to them, including this crucial principle of buying strength.
So a stock making new highs is actually demonstrating strength.
It's showing you real demand. It's telling you something important.
Our sources also detailed these core areas of expertise that Livermore thought were absolutely essential for any aspiring trader.
Yes, he placed emotional mastery right at the very top. The ability to control those psychological pressures that can derail even the most logical trader.
That constant battle within.
Totally. He also stressed a solid understanding of economics and fundamental analysis, to provide that broader market context.
Right.
Patience was another non-negotiable. The discipline to let winning trades actually run their course.
Harder than it sounds.
Much harder.
Mm-hmm.
Beyond these, he highlighted keen observation, focusing solely on objective market data, not noise. A sharp memory for learning from past trades, both good and bad, and a strong grasp of mathematics to interpret the numbers effectively.
It's fascinating that even back then, early 20th century, the psychological dimension was so clearly paramount. And later in his career, he adopted another crucial discipline, didn't he? About profits.
He did indeed. He recognized the wisdom of taking a portion of profits, often half off the table, and holding it in cash reserves.
Especially after a big win.
Especially after a significant gain, like doubling his initial investment. This acted as a vital safety net, and it provided dry powder for future opportunities. He also learned that constant trading is often counterproductive. Stepping away from the market during periods of uncertainty or when clear setups just weren't there.
Gave him clarity.
Allowed him to gain a clearer perspective on the major trends, free from the distractions of all that daily market noise.
And when he did decide to enter a trade, volume played a critical role in confirming his conviction.
Absolutely critical. Livermore believed that a surge in volume validated the initial move after a stock broke through a resistance level, confirmation.
And if the volume wasn't there?
The volume didn't materialize, or if the market failed to follow through as he expected, he wouldn't hesitate. Cut his losses quickly. Out.
Discipline again.
He constantly emphasized patience, waiting for the market to confirm his analysis. He also used the weakening of leading stocks and key industry groups as early warning signs.
For market tops.
Potential market tops, yes. As he observed in 1907 and again in 1929. Interestingly, he didn't always need to know why a stock was declining initially.
Just that it was declining.
The mere fact that it was consistently declining was enough to trigger his sell action. His overarching strategy was simple but effective. Long in bull markets, short in bear markets.
In cash and sideways markets.
Cash and sideways, indecisive periods. And he used his probing strategy to confirm potential trend changes and stop-loss orders. Always. A fundamental part of his risk management.
Can't trade without them.
And he paid close attention to how stocks within the same sector behaved. That group tendency which could provide really valuable clues.
It's remarkable how these principles, developed so long ago, still hold true. Our sources even point to successful trades in 2003, Strategies, NETC.com. That mirrored Livermore's emphasis on breakouts with increased volume after confirming an overall market uptrend. It just works.
Some things are timeless in the market.
Okay, let's shift our focus now. Let's talk about another legendary figure, Bernard Baruch.
Bernard Baruch. His early market experiences, much like Livermore's actually, were characterized by initial setbacks. He famously lost his entire investment in a tramway venture. Nothing more than a hot tip. A costly, but ultimately valuable lesson in the paramount importance of doing your own thorough research.
Lesson learned the hard way.
Definitely. He quickly realized that trading with borrowed money beyond his actual resources was just a dangerous game, and that achieving genuine success in the market is a marathon, not a sprint.
That's another recurring theme, isn't it? Takes time.
It really does, across all these masters.
He also lived through the Panic of 1893. That seems like an event that would profoundly influence anyone's approach, especially managing money for others.
Yes, absolutely. Witnessing the economic devastation of that era instilled in him a deep sense of caution and responsibility when handling other people's money.
But he still struggled personally.
He himself continued to struggle with overtrading, Even as his income grew, it led to multiple instances of him going broke.
Wow.
It wasn't really until he became a partner at A.A. Hausman & Company at the relatively young age of 25 that his career truly began to gain traction.
And his first significant victory came with American Sugar Refining, if I recall correctly.
That's right. After diligently doing his own research into the company, he bought 100 shares on margin.
Okay.
And as the stock price steadily rose over the next 6 months, he strategically used his accumulating profits to pyramid up,
Adding to the winner again.
gradually increasing his position. This ultimately resulted in a substantial $60,000 profit. It really solidified for him that potent combination of thorough research and the pyramiding technique.
Just like Livermore.
Mirroring Livermore's own experience exactly.
Baruch had a particularly insightful definition of speculation, didn't he? Drawing from Latin origins.
Yes, what's truly illuminating is his understanding of speculation. He saw it as observing the future and acting before it occurs.
Proactive.
Very. He stressed the critical need for decisive action and the essential skill of ruthlessly separating objective facts from the ever-present influence of emotional biases.
Which led to his nickname.
This unwavering reliance on data and evidence earned him the well-deserved nickname Dr. Facts later in his illustrious career.
Dr. Facts. I like it. He also showed a remarkable ability to bounce back from setbacks, didn't he? Recovering from a big loss in American spirits.
He did, through his own independent research into Brooklyn Rapid Transit. It really underscores the importance of not dwelling on past mistakes, but extracting those valuable lessons.
And the Soo Line transaction.
That profitable Soo Line deal further highlighted the value of rigorous independent analysis and, importantly, the intellectual flexibility to change your investment thesis when the facts change.
You can't be stubborn.
Exactly. Baruch understood the market as a constantly evolving landscape. It demands a flexible, adaptable mindset. His decision to move his offices closer to Wall Street in 1928.
Initially bullish.
Initially driven by a bullish outlook, but it soon revealed his keen sensitivity to subtle shifts in market conditions. He grew increasingly uneasy with the seemingly uninterrupted, relentless rise in prices throughout 1929. Felt wrong. Something felt off. And by his own account, he had largely exited the market before the catastrophic crash, still managed to post a very respectable $615,000 profit for that year.
Incredible foresight. Or maybe just incredible discipline.
Probably a bit of both.
Baruch is famously quoted on the absolute necessity of cutting losses quickly. It's a mantra that just echoes through all these great traders.
No speculator can be right all the time, he astutely observed. He firmly believed that even a modest success rate, say 3 or 4 profitable trades out of 10, could lead to significant wealth if one possessed the unwavering discipline to swiftly and decisively cut losses on the inevitable losing trades.
That loss control seems absolutely fundamental, non-negotiable.
It emerges as a fundamental, non-negotiable principle shared by all these legendary market participants. Absolutely.
He also held a very clear, insightful perspective on the relationship between the stock market and the broader economy.
Yes, Baruch viewed the stock market as a reflection of the underlying economy, not its primary driver.
Interesting distinction.
It is. He deeply understood the inherent dangers of unchecked optimism and the critical importance of remaining keenly attuned to fundamental shifts and evolving trends within industries and companies.
Like the railroads example.
He often used the declining prominence of railroads to illustrate how the market is in a constant state of flux of transformation. He placed far greater value on sound, independent judgment, and a comprehensive understanding of the big picture than on simply amassing vast quantities of raw, unfiltered information.
Quality over quantity of information.
Precisely.
And much like Livermore, Baruch recognized the pitfalls of chasing quick riches without putting in the work.
He firmly believed most people who lose money do so by harboring unrealistic expectations of effortless gains. He consistently stressed the vital importance of hard work, intellectual humility, and a continuous commitment to learning and self-improvement.
Humility seems key too.
Very much so. He also preferred to keep his investment positions private and to trade alone. He believed this solitary approach was most conducive to maintaining focus and avoiding the potentially distracting influence of others' opinions. Noise reduction, essentially.
Makes sense. While Baruch might not have had as many granular trading rules as Livermore, that principle of cutting losses quickly remained paramount, right?
Absolutely paramount. He also seemed to possess this keen intuition for selling into periods of market strength.
Like with the sulfur stocks in 1929.
Exactly, as evidenced by his strategic selling of those holdings then. He developed a refined feel for when prices were becoming unsustainably high, often initiating sales even as the market was still technically going up.
Selling on the way up.
Yes. And his significant near $700,000 loss in coffee trading served as a stark, unforgettable reminder to stick rigorously to what he knew best, to cut losses without hesitation and to let his profitable positions run.
Another hard lesson.
He often remarked that selling correctly was actually more psychologically challenging than buying.
Because of emotions, greed, maybe, fear of missing out more gains.
Largely due to those emotional factors, yeah. Which further reinforced his disciplined approach of selling into strength and quickly exiting any losing trades. His trading in 28 and 29, buying on strength one day, selling the next, based on his analysis, it just perfectly illustrates his adaptability.
Letting the market dictate, not ego.
Letting the market, rather than his own preconceived notions, dictate his actions.
Exactly.
Baruch's incredibly disciplined, thoughtful approach clearly paid off, not just financially, but in his long, influential life.
Okay, let's shift gears now and delve into the somewhat contrasting perspective of Gerald M. Loeb.
Gerald M. Loeb. His investment career began in 1921, and he offered a notably different perspective compared to, say, Benjamin Graham's value investing philosophy.
Right, Graham being the father of value investing, long-term holding.
Exactly. Loeb, having witnessed the devastation of the 1929 crash firsthand, famously viewed the stock market as a relentless battlefield. That was the title of his renowned book.
A battlefield. Intense.
It is. He came to believe that holding stocks for extended periods was simply an unnecessary and potentially catastrophic risk in such a dynamic environment.
And unlike so many others, Loeb managed to largely sidestep the worst of the 1929 collapse, didn't he?
Yes, he astutely recognized the significant market top occurring around September 3rd. That was nearly 2 full months before the major downward spiral really began.
Incredible timing again.
This remarkable foresight solidified his reputation as a highly skittish trader, one who favored capturing quick profits and diligently cutting losses short rather than embracing a buy-and-hold mentality.
And like the others, he thought most people fail because
He, like Baruch and Livermore before him, firmly believed the vast majority fail due to a fundamental lack of serious study and that unrealistic pursuit of rapid, effortless wealth.
Loeb also had a very specific definition of speculation itself, right?
He defined it as a careful study of the facts and reducing the risk by education and experience. He consistently emphasized that in the often unpredictable market, objective facts are the absolute cornerstone.
Facts, facts, facts.
His own considerable success stemmed directly from his exceptional ability to remain constantly attuned to subtle yet significant market changes and to capitalize on emerging trends, not just buying good stocks and holding indefinitely.
He was a strong proponent of a more active, shorter-term trading approach, wasn't he?
Indeed. Loeb held the conviction that holding stocks for a relatively shorter duration, typically within a 6 to 18-month time frame, was far more profitable than long-term investing.
And his reasoning.
He reasoned that accurately predicting the distant future in the stock market was a near impossibility, like trying to forecast the weather accurately many months out.
Fair point.
This fundamental belief directly influenced his preference for a more active, tactical trading style.
And like Livermore, Loeb was a dedicated tape reader. Believed success was earned through skill, not luck. He even had this intriguing perspective on which professions made the best and worst traders.
Yeah, that's particularly fascinating. His assertion that the most successful traders often have a background in psychology.
Why is it called?
Because they've developed a keen understanding of human behavior and its predictable influence on market participants.
Ah, the human element again.
Conversely, he argued that accountants often make the least effective traders
Because they're too rigid.
due to their inherent reliance on rigid valuation formulas and metrics, yeah. Loeb strongly cautioned against these inflexible approaches. He emphasized the critical need to trade in close alignment with actual market behavior, the real-time forces of supply and demand.
Not just theory.
Rather than simply adhering to theoretical models of how one thinks the market should behave based on static financial ratios like PE or book value, understanding the human element driving prices was absolutely key for him.
He also consistently stressed maintaining strict emotional control and basing decisions on clear opportunities, not just hope. And he had a unique way of conceptualizing stock life cycles.
Yes, he astutely likened stocks and their underlying companies to living organisms, each going through distinct stages: infancy, rapid growth, established maturity, and eventual decline.
And the key was knowing the stage.
He believed the crucial element for profitable trading was accurately recognizing which stage a stock was currently in, and then aligning your actions accordingly. The growth phase generally offered the most potential for substantial profit.
Right.
Ultimately, he deeply understood that human psychology, those inherent desires and fears, and the relentless pursuit of profits are the fundamental forces that drive all stock prices.
Loeb outlined a specific set of key qualities he believed were essential for successful traders.
He listed strong intelligence, a deep understanding of human psychology, the ability to maintain pure objectivity despite volatility, a natural mental quickness for timely decisions, and the capacity for original yet logical thinking.
Sounds like a tall order.
It is. He also issued a strong caution against the often inflated overconfidence that bull markets can easily breed.
That easy money feeling.
Exactly, like the dangerous belief that you've suddenly become inherently smarter than the market, or the tendency to get way too aggressive. He understood that while self-assurance is important, it must be tempered with humility and carefully managed risk.
He also placed a very strong emphasis on meticulously analyzing price and volume action, didn't he?
Absolutely. Loeb viewed volume as the single most definitive indicator of the true level of demand for a stock. He consistently stressed analyzing the dynamic interplay between price moves and trading volume.
Volume confirms the move.
Right. He believed that to achieve truly exceptional success, you needed to set ambitious goals, diligently control risk always, and exercise considerable patience while holding uninvested capital, waiting for those truly high-probability opportunities.
Patience again.
He often remarked that the stock market, in its essence, is far more a complex, nuanced art form than a precise, predictable science.
Discipline also emerged as another cornerstone of Loeb's philosophy.
Indeed. He firmly believed the highly competitive battlefield of investing demanded strict, unwavering adherence to sound disciplines. His primary strategy: first, gain a clear understanding of the prevailing general market trend before even considering any specific buy or sell decisions.
Know the tide before you swim.
Good analogy. He sharply contrasted successful investors, who can remain entirely out of the market when conditions are unfavorable, with those less disciplined folks who constantly try to force trades in dangerous or uncertain environments.
Overtrading.
He held a firm conviction that excessive trading, especially against the dominant market trend, is almost always a guaranteed path to losses.
And in direct contrast to conventional wisdom advocating diversification, Loeb was a strong proponent of concentration.
Very strong. He famously and unequivocally stated, "Put all your eggs in one basket and watch it very carefully."
Wow. That goes against everything you usually hear.
It does. His core belief was that focusing your capital on a smaller number of carefully selected stocks that you understand intimately and monitor closely would yield far superior results than spreading investments thinly across areas you might not know as well.
And he argued for less diversification with experience.
He did. He argued that the more experienced and successful you become, the less you should diversify. He personally amassed his considerable fortune by strategically concentrating his investments in the leading stocks of his time.
As a dedicated tape reader, Loeb naturally valued following real-time price movements. looking for strength in leaders before the averages confirmed it.
Exactly. He actively looked for signs of strength in leading stocks breaking out to new highs even before the major market averages caught up. Conversely, he grew cautious when prices were generally high and market optimism became excessively widespread. Everyone's euphoric.
Danger sign.
And he wasn't a big fan of relying heavily on price-to-earnings, PE ratios, for initial buying decisions.
Why not?
He viewed PE ratios more as a potential indicator of overvaluation after prices had already risen significantly. Loeb's incredibly disciplined and adaptable approach enabled him to navigate the extremely challenging bear market years, 1929 through 1932.
And he made money.
Not only successfully, but profitably, every single year. A real testament to his core principles.
Incredible. And he had some very clear, specific rules for the perfect trade.
His very first, most crucial rule: accept losses quickly and decisively. Limit them to a maximum of just 10% of invested capital.
The 10% rule, his insurance policy.
His essential insurance policy against catastrophic losses, yes. He also recognized the vital importance of volume. Strong up moves on high volume, bullish confirmation, up moves on decreasing volume, potentially bearish warning sign.
Got it.
He strongly advocated being willing to pay up for actively leading stocks in established bull markets, buying them as they broke out to new highs on increased volume in markets already trending up.
By strengths, not weakness.
He famously quipped the best stocks often initially appear overpriced. He consistently advised against trying to buy cheap or low-priced stocks, reasoning they're usually cheap for a good reason.
You get what you pay for, maybe.
Often, yes. He believed stocks get overvalued in bull markets, undervalued in bear markets, but he was primarily guided by the trend more than just the price level. He aimed for substantial gains, 1.52x capital in that 6-18-month time frame. And investing in actively advancing issues, even at high prices, was often the cheapest approach long-term.
And selling. Fewer defined rules there?
Fewer explicitly defined sell rules, yeah. But he generally advised selling when he began to feel overly confident.
Interesting psychological trigger.
Or when a stock's price advance started to stall despite increasing volume, or if the price started to decline on increasing volume. He also often recommended selling older leading stocks first when taking profits.
Loeb's active, trend-following, highly disciplined approach, yet another valuable, distinct perspective. Okay, let's turn now to Nicolas Darvas and his well-known box theory.
Nicolas Darvas, quite a character. Initially a highly successful professional ballroom dancer.
That dancer.
Literally danced his way into the stock market. Experienced some early, largely unsystematic profits with Canadian penny stocks.
Beginner's luck.
He quickly recognized it was more luck than skill. Yeah. And he actively sought a more reliable, systematic approach. He then experimented with following broker tips, focusing on traditional fundamentals like PE ratios.
But that didn't work well.
Limited success. Though he did begin to recognize the significance of industry groups and leader stocks during that time.
His first truly significant profit, the one attributable to his own analysis, came with a stock called Breland. That seems pivotal.
Absolutely pivotal. That $5,000 profit, earned through his own observations of the stock's price movements and volume, made him realize the actual price action in the market was the most crucial factor.
The market itself tells the story.
Following this epiphany, he dedicated himself to rigorously studying historical stock market guides, price charts, actively looking for recurring patterns, predictable behaviors.
And developed his own approach.
He actually developed his own hybrid approach, combining technical analysis, price volume, and fundamental analysis, company factors. He called it his techno-fundamentalist approach.
Techno-fundamentalist, okay.
And this became the foundation of his famous box theory.
Darvas arrived at a very fundamental insight about the nature of stocks, didn't he? Good versus bad.
He came to the profound realization that there are no inherently good or bad stocks in an absolute sense. Only those currently rising due to strong demand or falling due to selling pressure. Supply and demand.
Simple but powerful.
This understanding led him to trade less frequently and cultivate much greater patience, waiting for those really high probability setups.
And he had a key learning experience with his broker.
A very key one. His broker actively managed his account while Darvas was away on a dance tour. Despite the broker's efforts, the account generated minimal profit. Why? Because the broker prematurely sold his winners and stubbornly held on to his losers.
The classic mistake.
This eye-opening experience taught Darvas two invaluable lessons. Never sell a rising stock prematurely and always cut losses quickly and decisively. He also observed that investing in higher-priced stocks often yielded more reliable profits.
And he viewed losses as
tuition on Wall Street. valuable learning experiences, not failures. He identified common pitfalls he'd fallen into: chasing low-priced stocks, acting on tips, trying to buy fallen quality stocks.
He figured out timing was critical.
Ultimately, he concluded that the precise timing of his trades, relative to the stock's behavior within the broader general market, was absolutely critical, and that the anticipation of future growth, not growth already realized, was the primary driver of big profits.
Market behavior reflecting participant behavior.
Exactly. The collective actions and psychology of everyone involved.
After a significant period of study, trial, and error, Darvas finally developed his own unique technical trading rules, which ultimately proved remarkably successful.
Yes, after enduring his share of losses while experimenting, his distinct focus on pure price action finally clicked. He went on to achieve an astounding $2.25 million in profits.
Wow.
In just a short 18-month period. After refining and consistently applying his proprietary strategy.
That's incredible.
His success became so notable, the American Stock Exchange even temporarily suspended the type of stop-loss orders he routinely used.
Really?
Yeah. He ultimately attributed his huge success to two key secrets: unwavering self-discipline and patient fortitude, waiting for the right opportunities.
Discipline and patience again. Okay, let's delve deeper into his core concept, the box theory. It's quite distinctive.
It is. Darvas observed stocks tend to move in discernible trends, but these trends are often punctuated by periods of consolidation, sideways movement at specific price levels, resistance areas.
Like pauses.
He ingeniously likened this price action to a rubber ball bouncing within the confines of a clearly defined box. The stock price would essentially oscillate between a defined high and low point, the top and bottom of the box.
Okay, I can picture that.
The crucial element of his theory was to monitor the price action closely and, most importantly, watch for a decisive breakout above the upper boundary of that established box. Especially when accompanied by a significant increase in trading volume. For Darvas, that breakout on increased volume was a strong indication the stock was likely ready to advance to a new, higher level. Enough buying demand to push it into the next series of boxes.
Didn't need to know why, just that the demand was there.
Exactly. Focused on the clear evidence of sustained buying interest. He also astutely observed different stocks had distinct personalities, some more volatile, others quieter.
And his system was about capital preservation, too.
Unlike long-term investors holding losers hoping for a turnaround, Darvas's system was specifically designed to proactively preserve capital and maintain confidence by quickly exiting any positions that started moving against him.
And he preferred to trade alone.
Strongly preferred to operate as an independent trader, relied solely on his own study of price movements from barons, consciously avoiding the distracting opinions of others.
Like Baruch.
Furthermore, he typically concentrated his investments in a small number of stocks, usually just 5 to 8 at a time.
Concentration.
And he recognized the paramount importance of trading with the prevailing general market trend. Understanding most stocks follow the broader market.
Even after success, he kept learning.
Remained a dedicated student of the market, continuously learning, refining his system. He even made the disciplined decision to completely stop trading in 1961 when he couldn't find any new compelling buys fitting his strict criteria.
And that helped him
Successfully avoided a significant market downturn that followed. Discipline paid off again.
His techno-fundamentalist approach. It focused on stocks that held up best during corrections, right? Not fallen leaders.
Exactly. Identifying those stocks, demonstrating the least price decline during corrections, as these often represented potential new leaders, frequently possessing strong underlying fundamentals.
And his use of pilot buys seems like smart risk management.
Very smart. He'd initiate very small initial positions, pilot buys, to cautiously test the waters, gauge the market's reaction. His famous trade in E.L. Bruce illustrates this perfectly.
How?
He gradually increased his position size in multiple increments as the price continued to rise and confirm his analysis, always using carefully placed stop-loss orders. In that case, he held through a trading suspension, a short squeeze, and ultimately realized a very substantial profit. He also consistently emphasized regularly taking profits off the table into reserves, safety, and capital for future opportunities.
Like the others, he also struggled with overconfidence sometimes.
Like many successful traders, yeah. Darvas experienced periods of overconfidence that led to mistakes, but he always had the discipline to return to his well-defined rules after any setbacks. He continued holding winners like Universal Controls and Theocol until they showed clear signs of weakening, then sold for significant gains.
Our sources provide a compelling modern example of his box theory with Omnivision Technologies in 2003, showing that stair-step pattern. His journey is a powerful testament to perseverance, learning, and sticking to a system. Okay, finally, let's turn to the highly influential strategies of William J. O'Neill and his widely recognized CAN-SLIM system.
William J. O'Neill, a more contemporary figure among these legends. He was significantly influenced by studying the remarkable success of Jack Dreyfus's mutual fund.
What did he learn from Dreyfus?
O'Neill meticulously analyzed the fund's historical purchase records and made a key discovery. Virtually all their successful investments were initiated in stocks breaking out to new price highs after forming well-defined base-building patterns.
Buying new highs again.
This pivotal observation became a cornerstone of his own highly effective strategy. By diligently applying his own evolving rules, O'Neill achieved an astonishing 20-fold increase in his personal portfolio.
20-fold.
In just 18 months between 1962 and 1964, starting with only $500.
Incredible. And he adopted Livermore's pyramiding, too.
Yes, adopted and effectively used Livermore's pyramiding strategy to amplify gains.
He also experienced some early setbacks, though, didn't he? Like the others.
Yes, his initial significant gains in 1961 were rather quickly erased when the overall market unexpectedly reversed trend.
Humbling experience, I bet.
This prompted him to dedicate the rest of that year to meticulously analyzing every single trading transaction he'd made. That critical habit of rigorous self-assessment again.
And this deep dive into his own trades led to crucial discoveries about successful growth stocks.
Through his detailed analysis, yes. He observed the most successful growth stocks typically rise maybe 20–25%, then consolidate, form new price bases, before embarking on their next significant upward advance.
Stages of growth.
He also noted a particularly powerful characteristic. Stocks surging past their initial pivot point, that key breakout level, and gaining 20% or more within the first 3 weeks after the breakout, tend to become the market's biggest winners, and should generally be held for a minimum of at least 8 weeks to maximize gains. The 8-week hold rule.
Interesting. And his core profit-loss rules.
His core plan involved proactively taking profits around the 20% gain level, except for those exceptionally fast movers showing unusual strength. And, perhaps even more importantly, strictly cutting any losses at a predetermined 7–8% below his original purchase price.
That 7–8% cut seems ironclad for him.
Absolutely. He also recognized the power of strategically pyramiding into his strongest performers within a tight 3% range above his initial purchase, effectively forcing capital into his highest conviction trades.
And he saw leaders topping as a market warning sign.
Astutely recognized that the topping action of leading individual stocks often serves as a reliable early warning sign of a more significant general market decline, maybe 10% or more, led him to pay very close attention to the overall market health.
O'Neill's strategy is very heavily grounded in studying historical market winners, isn't it?
Absolutely. His extensive ongoing research, dating back to 1953, meticulously compiled in his influential The Model Book of Greatest Stock Market Winners, forms the very bedrock of his highly systematic approach.
And his track record speaks for itself.
His own impressive track record of consistently identifying and profiting from major market winners, Pick and Save, price company AOL, Charles Schwab, speaks volumes.
And that famous Wall Street Journal ad.
His bold, now famous, full-page WSJ ad in early 1982, definitively calling a major market bottom, further solidified his reputation as a highly astute, data-driven investor.
And this extensive historical research led ultimately to CAN-SLIM.
Exactly. CAN-SLIM is that powerful, easy-to-remember acronym representing the 7 key fundamental and technical characteristics O'Neill observed were consistently present in most great winning stocks, just before their biggest price advances.
Let's break that down later. It's been proven effective by others too, right?
Yes. The success of numerous individual investors like David Ryan and Lee Freestone using CAN-SLIM to achieve top rankings in national investing competitions highlights its practical effectiveness.
O'Neill has also shared his wisdom through best-selling books like How to Make Money in Stocks. He emphasizes success requires time, study, persistence.
A significant commitment, yes. And his strict rule on cutting losses remains absolutely paramount, doesn't it?
His unyielding rule. Cut all losses at 7–8% below purchase price. Completely non-negotiable. It is, in his own words, his essential insurance policy against catastrophic losses.
The insurance policy. I like that framing.
He also establishes specific profit targets, like maybe 130% projected PE growth as a potential sell signal for top growth stocks, or aiming for more modest 20% gains in challenging markets.
Right, adapting to conditions.
And he advocates for that disciplined practice of keeping a handwritten record to analyze past trades.
Meticulously analyze all past decisions, winners and losers, a critical tool for continuous learning and improvement. He also stresses filtering out less significant technical indicators, focusing primarily on signals from overall market behavior and leading stock price action. Psychological indicators are secondary.
And doing your own research.
A firm believer in conducting your own independent research, forming your own conclusions, not blindly relying on Wall Street analyst recommendations.
Interesting contrast with Livermore and Loeb as tape readers. O'Neill found that too difficult.
He found tape reading too emotionally taxing, yeah. His publications aim to provide actionable insights without needing that constant minute-to-minute monitoring.
So his number one unwavering rule remains.
Cut all losses decisively at 7 to 8%. He famously stated, "All stocks are bad unless they go up," unequivocally underscoring the absolute primacy of strict loss control. His rules are driven by historical data analysis. He adheres only to principles proven successful over long periods. Okay, let's quickly touch on the specific criteria that make up that CAN-SLIM system.
Certainly. C is for current quarterly EPS growth. Looking for 25% or more, ideally much higher. 70% plus is often better. Accompanied by strong, accelerating sales increases, also typically over 25%.
Got it. C, current earnings.
A emphasizes strong annual earnings increases, at least 25% for the past 3 consecutive years, plus a high earnings per share EPS rating, 80 plus in Investors Business Daily.
Annual earnings. Makes sense.
N looks for new products or services, new management, or the stock making significant new price highs. Ideally buying these leaders as they emerge from sound constructive base patterns.
New, something driving future growth. S carefully analyzes supply and demand, favoring smaller caps that are easier for strong demand to move higher, looking for significant volume increases on days the stock makes new highs, generally avoiding excessive stock splits.
So less supply, more demand pressure.
Company buybacks are positive, low debt-to-equity preferred, strong volume on up days is key. His research showed many great past winners had relatively small floats, often under 25 million shares, before their big moves.
S, supply and demand. Okay.
L focuses on identifying market leader or laggard stocks within their industry groups. Strongly urges concentrating purchases in the strongest leaders in the strongest sectors.
By the best of the best groups.
Look for stocks with high relative strength, RS rating, 80 plus. Confine buys to the top 2 or 3 companies in the top-ranked industry groups. Industry group strength is critical.
L leader. Got it.
I examines institutional sponsorship, specifically looking for increasing recent ownership by top-performing institutional investors. Strong institutional sponsorship validates a stock's potential, shows the big money is interested.
I, institutional sponsorship. Smart money.
And finally, M underscores the absolutely crucial importance of understanding and closely following the overall market direction.
Well, trend is your friend.
Emphasizing that roughly 3 out of 4 stocks will ultimately follow the prevailing general market trend. Essential to align your trading with the broader market's health and direction. Don't fight the tape, as they say.
Market direction. Absolutely critical. Okay, so that's CAN-SLIM. He also emphasizes specific CART patterns, right?
Yes, well-defined patterns like the cup with handle, double bottom, flat base are key indicators in his technical analysis.
And the buy point.
Strongly advises buying at clearly defined pivot points as stocks emerge from these constructive bases, only when accompanied by a significant volume increase, signaling strong demand.
Avoids sloppy patterns.
Cautions against buying stocks with wide, loose price action, or those emerging from very late stage like 4th stage or later bases. Sound bases typically show more up weeks on high volume, tight consolidation periods, and occasional volume spikes.
And pullbacks are normal.
Acknowledges normal, healthy pullbacks to the pivot point where the 50-day moving average can, and often do, occur during a healthy uptrend.
And at market top warnings.
Warns of market tops often being signaled by an increasing number of distribution days.
Which are?
These were major indexes decline on increasing trading volume, shows selling pressure. Advises investors to actively sell into market strength rather than waiting for the inevitable downturn.
Sell while things still look good.
Basically, yes.
It's truly remarkable seeing these consistent, recurring themes weaving through the strategies of all these legendary traders.
Indeed. Despite diverse eras, individual approaches, several fundamental commonalities just leap out. A relentless work ethic was crucial for every single one.
Oh, shortcuts.
They all understood peak success demanded significant dedication, persistent effort, continuous learning. They all grappled with their own powerful emotions.
The internal battle.
And ultimately learned to control those impulses by establishing and rigorously adhering to well-defined systematic trading rules.
Rules provide discipline.
They each developed exceptional observational skills, honing their ability to accurately interpret the often subtle signals from market action itself. A strong sense of self-reliance in research and trading was another shared hallmark.
Trading alone, often.
Many preferred keeping trades confidential, using multiple brokers. Nose reduction again. The disciplined practice of taking profits off the table into cash reserves.
Baruch, Loeb, Darvas did that.
Providing capital preservation and flexibility. O'Neill generally favored reinvesting strategically into new leaders. And perhaps most notably, all of them, to varying degrees.
Believed in concentration.
Believed in the power of concentrating capital in a relatively small number of leading U.S.-based stocks rather than broad diversification. Echoing Loeb's famous, put all your eggs in one basket and watch that basket.
And when we look at their common trading rules, clear patterns emerge. Valuable lessons for today.
Without a doubt, number one rule, emphasized by every single one, limit losses quickly, decisively.
Absolutely number one.
They all embraced the counterintuitive but highly effective strategy of buying stocks breaking out to new highs after constructive bases. Buy high and sell a lot higher.
Buy strength.
The technique of pyramiding, adding to winners as they advance, was another shared, highly profitable tactic. They all focused on identifying emerging new market leaders each cycle, not clinging to past winners.
New cycle, new leaders.
The critical importance of volume as a reliable indicator of strong demand was consistently recognized. And finally, they all learned the invaluable lessons of holding on to winners, resisting selling too quickly, while also understanding the wisdom of selling into strength.
This has been an absolutely fascinating, incredibly insightful deep dive into the minds and methodologies of these legendary stock traders. To bring our discussion to a close, what are the key recurring lessons listeners should really take away and consider applying?
Okay, boiling it down. First, the paramount importance of ruthlessly cutting losses quickly cannot be overstated. Just do it. Second, embrace buying high in fundamentally and technically strong leaders. It feels wrong, but history shows it works.
Right.
Third, focus your attention and capital on a concentrated portfolio of these leaders. Know them well. Fourth, cultivate absolute discipline and strict emotional control. Your rules are your shield.
Discipline is key.
And finally, recognize the market is dynamic, always evolving. Commit to continuous learning and adaptation. You're never done learning.
Excellent summary.
And now, a final thought-provoking question for you, our listener. Consider deeply which of these time-tested principles resonates most strongly with your current approach. Are there any deeply ingrained beliefs or practices you might now feel compelled to reevaluate in light of the collective wisdom of these greatest traders? And perhaps most importantly, what's one small yet potentially impactful actionable change you could realistically implement in your own trading or investing routine based on these profound insights as you continue your own exploration of the fascinating world of the stock market?
Good question to ponder.
Thank you for joining us on this deep dive.